Morning, welcome to Ainsley News. Start of the week, it's Monday the 15th of February. Today we're talking another Wall Street record versus gold. Another day, another record. For the first time in history, the US share market is valued, or more accurately, priced at twice the US economy measured by GDP. Remember, price is what you pay, value is what you get. Don't get the two confused. Last week, the total US share market was priced at $41.8 trillion. The IMF's estimate of the 2020 US GDP was $20.8 trillion. That's a 201% increase in equities to GDP ratio. Over the past century, whenever that ratio hits a high, gold goes on to make strong gains as the value of the equities inevitably corrects. The chart below that we're going to show you paints that very clear picture and also puts into perspective the nosebleed levels that we're at now. Note, the gold price is in a logarithmic scale, just to whet your appetite a little bit more. Here's that chart here. There's that crossover point there. Equities is in red, US dollar gold price in yellow. Wow. The author of the chart further demonstrates the unreal nature of this US equities market, where it is one based on stimulus and hope rather than the true fundamentals of earnings. This chart here, real S&P Composite Stock Price Index in red, and the real S&P Composite Earnings Index. So that's stock price versus the companies that are in their earnings. Huge disparity there. Doesn't seem real, does it? While we always talk about the price of gold arguably being undervalued and the factors that will drive it up, the author of these charts comes in at it from a different and arguably fundamentally more correct angle. This from them. One can argue that the real price of gold, corrected for inflation, is currently not undervalued. As I've written in previous article, gold's purchasing power is fairly constant. Today, gold buys you roughly the same amount of commodities and goods and services as it did 50, 100 or 200 years ago. However, according to my analysis, fiat money is strongly overvalued. As fiat is the air for the present financial bubbles, fiat facilitates the excessive leverage in the economy. When the bubbles eventually burst, fiat's value will be corrected, inflation goes up, and the gold price denominated in fiat rises. The Fed has printed over 20% of all the USD currency ever created in just the last year. Let that sink in. That money has to go somewhere, and it has inflated the mother of all bubbles in most financial and property assets. To date, it has not caused inflation, but the new agenda of fiscal stimulus more directly to Main Street and not Wall Street threatens to that change and potentially change dramatically. Well, that's news for today. Hope you liked that little bit of insight there. Remember ainsleyBullion.com.au for all things physical to grab your real gold, silver and platinum. Into cryptocurrencies, Bitcoin's still flying, jump over to ainsleywealth.com.au. And if you're after a bit more of a portable gold and silver solution, check out the goldsilverstandard.com. Cryptocurrency backed by real gold and real silver, built by Ainsley, stored at Reserve Vault. We'll catch you tomorrow for more news.